All right, let's talk about protecting your home because that's a common asset everyone has. And in order to do that, I want to hit the trifecta. This is the business structure that we use in our law firm to plan clients' assets and tax planning. When we do a trifecta, we are doing two things with the client. We're identifying how we want to minimize their taxes and how we want to maximize their asset protection. There are three components to a trifecta. That's the tri. There's going to be your trust, which this is just your revocable living trust. It is owned by you. This will own, let's say here, an LLC that owns a rental and it owns your personal residence. Now, you might have your W-2 over here. This is where you're working and this is your business. This is assets over here. This could be an S Corp. These are the three quadrants. We have you with your trust. We have your LLC that could hold some assets. We'll talk about the different things here and variations. We'll build on this. And then we got your W-2 or your business or side hustle over here on this right side. Okay, my personal residence. First of all, that's either owned by me or owned by my trust. We do not put your personal residence into an LLC. The reason we don't put it in an LLC is LLCs are designed to protect the risk happening at the LLC from other assets. So for example, if I put an LLC and had my home owned by an LLC, and let's say I had a lawsuit, okay? Some neighbor kid, gets hurt on the trampoline or whatever, I don't know, okay? And they want to sue you. Well, it's like, well, you got to sue my LLC. Okay. Well, when someone sues an LLC, they can still get at the assets the LLC owns. So that didn't protect the home itself. It might have protected my other assets that I have, but that didn't protect the home itself. So I'm not protecting the equity in the home by using an LLC for the home itself. Now, if I have a rental property or I've got a business, I want to have an entity there, an LLC or corporation. So if something happens in the rental, they have to sue the LLC. If something happens in the corporation, they have to sue the corporation and they're stuck there. They can get at the assets in that entity, but they can't get over to other entities. They can't get down to my personal assets here. But we don't want to use an LLC. That's not going to protect the equity in and of itself. So how do I protect the equity in my home? Well, we protect the equity in the home by identifying where you have risks. If you're a business owner, let's say you're the contractor, okay, and you're working on a lot of properties, you have a lot of projects, or you're the doctor, whatever, you have a lot of surgeries or things that could be high risk where you get sued. Well, we want an entity for that business. That's over here on this left side where you're working and have a business. If I have a lawsuit and I'm the contractor, they're forced to sue the entity. They can't come over here and get down to my personal assets. They can't get over to my rental properties and assets on the right side. They're stuck at the business entity itself, okay? They're stuck at that S Corp or LLC that I might have. So I want to identify where I have liability, and I'm going to use the entity there to contain the liability where it is created. That's the first thing I'm going to do to protect my personal residence. So like myself, I have S corporations, other corporations, LLCs, and all these things conducting business activities that if a liability happens in my life, it's most likely going to happen in one of the business activities. The operating business, it's going to happen on one of the rental properties, whether it's a short-term or long-term, and that's going to get contained in that entity itself. It's not going to come down to my personal assets, not from my business income coming out of my entities. It's not going to touch my home or any other assets. So that's step number one, create the entities to protect your personal assets from your business or investment risks. The second thing you want to look at doing to protecting your home is equity stripping. Equity stripping is basically a technique where you don't leave a lot of equity in your home. If you have a creditor that's going to come after you, one of the things they might do is go after your home, okay? And so if we look at the home here, let's go over the strategies, okay? Number one, I'm going to use LLCs and corporations, and I'm going to use those to protect my home from business risks or liability. Second, I'm going to equity strip. I'm not going to leave equity in my home for a creditor to get at. There's a couple ways you could do this. The easiest is maybe just a home equity line of credit. The reason I like the home equity line of credit, it's legit. You get it from a bank, and most banks are going to put a lien on the property up to the limit amount, whether you draw on it or not. So if you got a home worth $2 million and you got $1 million mortgage outstanding on it, you've got another $1 million of equity. Well, you might be able to get a home equity line of credit up for another $600,000, $800,000. And that bank is going to put a lien on the property for that $600,000, $800,000, whether you draw on it or not, typically. And so now I've got this lien on the property that if a creditor's chasing me down, they're not very interested in going after my home, okay? So there's the home equity line of credit or using equity stripping. Now, some people say, why don't I just put a fake lien on there or something to make it look like there's a loan? That stuff doesn't work at the end of the day. If you really have a problem, that thing's not going to stand up. So these kind of phantom liens or things like that, you really don't see them in real asset protection planning because they just don't work at the end of the day. Okay, the third thing is the homestead exemption. Okay. Every state has something called the homestead exemption. So you want to know this for your state because the homestead exemption will protect a certain amount of equity in your home. Some states might give you like $20,000 of equity in your home that's protected in the event of a lawsuit. A creditor could not sue you and go after your home and make you sell your home unless you exceeded this protected amount in the homestead exemption. Now on the low end, you might have states that are like $20,000 or so to $50,000 or $100,000. Most states are around 100 to a couple hundred grand of equity that they protect in the home that they won't let a creditor sue to go after. Some states have an unlimited exemption, like Florida, for example. Florida has an unlimited homestead exemption. So if you're a wealthy person getting chased, you can go by creditors, go move to Florida and go buy a $50 million home and put all your money and assets into the home and reside there, and it's going to be protected from creditors. Now, that is seriously stuff that happens. Why do a lot of, people with, if you remember the Enron case, many of you are old enough to remember Enron, tons of financial fraud, publicly traded energy company, all the executives got charged with fraud and had judgments against them. And where did they all go? Florida, and bought houses. O.J. Simpson, remember O.J. just recently passed away. But what happened in his case is, he was not guilty criminally in the murder trial, but was held civilly in the civil trial. And so he had a judgment against him for $30 million. Well, there's two things that OJ did that allowed the creditors never to collect on that. One, he moved to Florida and later moved to Nevada because Florida had an unlimited homestead exemption and they couldn't go chase his home. The second thing he did is the majority of his assets that he lived on after the case was his NFL pension, which we're going to get to protecting retirement accounts and how that was protected even from creditors in a civil case that revolved around murder. So retirement accounts are going to get protected. We're going to talk about that here, but remember the homestead exemption. Look up your state. Now, some states require you to affirmatively file something to claim the homestead exemption. I believe Texas is one of those states. Some states you automatically get it. So you might want to look it up in your state. If you do an asset protection analysis with our lawyers at KQS Lawyers, they'll help determine that. But for the most part, most states it's automatically granted. Again, there are some you have to affirmatively state that and file something at your state. We typically, if you look at the diagram here, this trifecta, your trust should own your personal residence. Now, this trust here is a revocable living trust. I'm going to talk about trust for asset protection, but for most clients, 99% of our clients, we're just going to use your typical revocable living trust for your home. That's what I just use a regular revocable living trust that owns my home. And again, the reason for that is I'm using entities like LLCs and corporations to contain the business risk at the business level so it doesn't even come down to my personal assets. Like if something happens in the business, they're stuck here. They can't come down over to the LLC that owns rentals. They can't come down to my trust. They can't come over to this. That's all protected, okay? Same thing if there's a rental property. They're stuck at the LLC. So my home is protected. I don't need an LLC around it itself. And remember, even if you did have an LLC on your home, that is not going to protect the equity in the LLC, which is the home itself. So we're going to use the other entities for that. But those are going to be your three strategies on protecting your home. First, use an LLC or corporation to protect your business liabilities from your personal assets, your home being the personal asset. Second, if you have a lot of equity in the home, consider stripping out the equity. Sometimes this is a great wealth building tool. Strip out the equity to go buy more assets, investable assets, more real estate that could be income producing, with other financial accounts or brokerage accounts. I mean, those are places where you can certainly strip out equity to put that asset. And the third thing, remember the homestead exemption. This varies state by state. There's 50 different rules on this, but that protects a certain amount of equity in your home automatically. There's a few states where you do have to file to affirmatively claim it, but there's a certain amount of equity automatically protected in your home by law in all states. I hope you found value in that video and took something away from there that can help you on your wealth building journey. Make sure you're subscribed though to the channel because I got tons of information I want to share with you to make it easier, faster to build wealth.